What is a mutual fund? In today's video, we are going to explain what a mutual fund is, how it's used by investors, and some of the key components of this investment vehicle. A mutual fund is an investment vehicle that pools money from multiple investors to purchase a diversified portfolio of stocks, bonds, and other securities. Each investor owns shares of the fund, which represent a portion of the holdings of that fund. The value of these shares is determined by the performance of the securities in the fund's portfolio. Mutual funds are managed by professional portfolio managers who make decisions about which securities to buy, hold, or sell to meet the fund's investment objectives, such as growth, income, or other criteria. Mutual funds are a popular investment choice because they offer diversification, professional management, and are accessible to individual investors, often with relatively low minimum investment amounts. Like ETFs, mutual funds offer investors key features such as diversification, liquidity, and a variety of investments. Unlike a broad market index as the S&P, mutual fund has a specific investment strategy or objective. The fund's objective determines what kind of securities it will invest in. Objectives may include growth, income, capital preservation, or other criteria. Based on the objective, mutual funds can be classified into broad categories such as equity funds, bond funds, money market funds, balanced funds, etc. These categories are further narrowed down into specific mandates such as Canadian large cap, U.S. mid cap, European large cap, U.S. treasuries, U.S. investment grade credit. It's key to understand that the portfolio managers who make the investment decisions have a narrowed focus on concentrated segment of the markets that match with the expertise and knowledge. Mutual funds are valued using a metric known as the net asset value, or the NAV, which represents the per share value of the mutual fund and is calculated by taking the total value of the fund's assets, subtracting liabilities, and then dividing that result by the number of outstanding shares. A market value of securities. The primary assets of a mutual fund are the securities, stocks, bonds, etc. it holds. The market value of these securities is determined by their current prices on the exchange where they are traded. Daily valuation. Mutual funds typically value their assets at the close of each trading day using the closing prices of the securities that they hold. When calculating the total asset value of all the securities in the fund's portfolio are summed up together. This includes any cash or cash equivalents that are held by the fund. Any interest or dividends earned by the fund securities but not yet received is added also to the total asset value. Liabilities of the fund include any fees owed, such as management fees, operating expenses, or any other costs. These liabilities are subtracted from the total assets of the value of the fund to arrive at the net NAV, or net asset value. Calculating the NAV. The NAV is calculated using the following formula. It gives you a per share value. The result is the NAV per share, which represents the value of each share of the mutual fund. Reporting and publication. The daily NAV is calculated at the end of each trading day and is typically published by the next day. It's the price at which investors can buy or sell fund shares. Mutual funds are required to publish their NAV daily and is available through financial news outlets, the fund's website, and other platforms. Since the NAV is based on the market value of the fund's holdings, it can fluctuate daily depending on the performance of the securities in the portfolio. When a fund pays out dividends or capital gains to its investors, the NAV typically drops by the amount that's distributed, as these payouts reduce the fund's assets. Like any product or service, it comes with a cost. The cost of a mutual fund to its investors is known as the management expense ratio, or MER for short. The management expense ratio of a mutual fund is a key metric that represents the total annual expenses incurred by the fund, expressed as a percentage of the fund's total average assets. MER includes various costs associated with running the fund, such as management fees, administrative fees, and other operational expenses. It is an important figure for investors to understand because it directly impacts the overall return of the investment. Management fees. These are the fees that are paid to the fund's management company for the day-to-day management of the fund, including investment research and their portfolio management. Administrative fees. These cover the costs of record keeping, accounting, auditing, legal services, and other administrative tasks necessary to operate the fund. Operating expenses. These can include costs for marketing, distribution, sometimes called the 12B1 fees in the US, other miscellaneous expenses required to manage the fund. Taxes. In some jurisdictions, taxes may also be included in the MER. How the MER affects investors? The MER is deducted from the fund's gross returns, meaning that the higher the MER will reduce the net return that investors receive. For example, if a mutual fund earns a 7% return, has a MER of 2, the net return would be 5. A comparison tool. Often investors use the MER to compare the cost efficiency of different mutual funds. Generally, lower MERs are preferred because they allow the fund's returns to flow through to the investor. Overall, mutual funds can be a good investment option for retail investors because they offer diversification, professional management, liquidity, variety, and convenience. For simple investors who do not have the interest or the time to manage their own investments, a mutual fund is a suitable option.